On May 16th, Indian gold prices experienced a severe correction. The price for 100 grams of gold dropped by nearly 10,000 rupees. Looking at this dual-axis chart, you can see that sharp May 16th price drop, which pushed 10 grams of gold well below the 1.57 lakh mark. Typically, geopolitical tensions in the Middle East drive investors toward gold as a safe haven, pushing prices up. But right now, despite ongoing conflicts, the market is aggressively selling off. This leaves buyers with a difficult calculation to make. Are you looking at a brief discount window or the start of a prolonged slide in value? Answering that depends entirely on your position in the market. A tactical trader analyzing price charts faces a very different reality than a retail consumer buying physical jewelry. For the pure investor, the calculation is strictly about asset accumulation. The goal is to secure investment-grade bullion at the lowest possible spot price. To figure out your best move, we need to look at the macroeconomic forces driving this sell-off, the ground realities of retail jewelry pricing, and the specific technical levels where the crash might bottom out. Jumping into the market based on headlines alone is a fast way to lose money. You need to match the specific market data to your personal buying intent. To understand why gold dropped 10,000 rupees in India, we actually have to look at the United States economy. Recent U.S. economic data has come in stronger than expected. Growth and inflation metrics are holding firm, altering global market expectations. Because the economy is running hot, the Federal Reserve is actively delaying the interest rate cuts that the market had been counting on. When U.S. interest rates stay high, government bonds yield more. That pulls global capital away from other assets and heavily strengthens the US dollar. This quadrant chart maps out the inverse relationship causing the crash. Because gold doesn't pay a yield, a strong US dollar makes holding it less attractive to investors. That massive selling pressure has completely overpowered any safe haven buying stemming from US-Iran tensions. This 10,000 rupee drop is the direct result of a dominant US dollar dictating the current flow of global trade. That explains the global commodity market. But if you are walking into an Indian jewelry showroom today, the math changes. The baseline for investment-grade gold is 24-karat purity. Right now, that sits at roughly 15,704 rupees per gram. 24-karat perfectly tracks those global spot prices we just discussed, but it is physically too soft to be crafted into wearable jewelry, and keeping it requires secure, insured storage. If you want a functional piece, you are looking at alloys like 22-karat, currently priced around 14,300 rupees per gram, or 18-karat, mere 11,700. Buying wearable gold means gaining a durable asset you can use for daily wear or events. In exchange, you accept a lower absolute purity and sacrifice part of your capital to making charges that you cannot recover on resale. This bar chart compares May 16th base rates for 24-karat and 22-karat gold across major retailers like Tanishq, Malabar, Kalyan, GRT, and Joselucas. The price variation between these brands is negligible, often less than 50 rupees per gram. Choosing your jeweler based on fractional differences and today's base rate is a mistake. Your financial leverage lies entirely in negotiating who offers the lowest making charges and the clearest buyback policy. If you aren't buying physical gold and are instead trading MCX futures, your strategy relies entirely on timing and technical data. On this technical price chart, prices are trapped in a consolidation zone, oscillating between 158,000 and 159,000 rupees. Right above sits an immediate resistance ceiling at the 160,000 to 164,000 mark. The price repeatedly struggles to break through this level. If momentum fails to crack that ceiling, the price will likely slide. The first safety net is a support floor at 154,000 to 155,000. Below that is the deepest value zone between 150,000 and 152,000, where heavy institutional buying should halt the crash. As a trader, you face a distinct choice. Wait for prices to hit that 150,000 floor to maximize your upside, or buy in early and risk missing a better entry if the slide continues. The current chart reflects deep caution among institutional buyers. Until price action breaks definitively towards support or resistance levels, patience is a measurable financial asset. Surviving a market correction requires throwing out generic advice and locking into the strategy that matches your specific timeline. This three-column matrix maps out exactly how to proceed. Let's start with the long-term accumulator prioritizing 24-karat bullion. Begin laddering purchases now rather than timing the absolute bottom, and keep cash reserves ready in case prices drop to the 154,000 support level. Next is the jewelry consumer, focused on 22-karat and 18-karat retail goods. A 10,000 rupee drop makes this an exceptionally favorable window to execute any planned jewelry purchases for upcoming events. Remember the rule for retail. Ignore the tiny per-gram differences between major brands and put all your energy into negotiating the making charges. Finally, we have the active trader, looking at MCX futures. In a choppy market, avoid aggressive entries. Wait until prices either cleanly break above the 163,000 resistance or drop into that deep 152,000 value zone. Whether you are securing 24-karat bars, buying a 22-karat necklace, or trading futures, a price drop only becomes a crisis if you don't understand your timeline and the specific utility of your assets.